Information from the Statement of Financial Position and Statement of Income is given below for North Road Inc., a company following IFRS, for the year ended December 31st. North Road has adopted the policy of classifying interest paid as operating activities and dividends paid as financing activities. And we're given the comparative statement of financial position at December 31st, and we can see the 2020 and the 2019 balances. We're given a partial statement of income as well, or actually a full statement of income. And we're given some supplementary information. Investments in land were sold during 2020. At a gain during 2020. Equipment costing $56,000 was sold for $10,550, resulting in a gain. Common shares were issued in exchange for some equipment during the year. No other shares were issued. And the remaining purchases of equipment were paid for in cash. And we're asked to prepare a statement of cash flows for the year ended December 31st, 2020, using the indirect method, and then next, the direct method. Okay, so let's start here. So let's do the direct method first, and we'll just do it right beside so we can see the information easily. Okay, so the indirect method. So the first thing we're going to do is set up our cash flow statement. This is definitely the easy part. We're just going to put the name of the company, North Road Inc. We're going to have that it's a statement of cash flows. And we're going to say for the year ending December 31st, 2020. Okay, so the indirect method, the first thing we always do with direct or indirect is we first start our heading. So we know that we hide off each of the sections. We're going to have cash flows from operating, cash flows from investing, and cash flows from financing. Now we don't know how much space we need, so I'm just going to start with my first title, which is cash flows from operating activities. Okay, and the first thing that we do in the indirect method, remember the indirect method is where we're going to start with net income and then we're going to reconcile it back for non-cash items, and then we are going to go from there. The direct method is where we're actually looking specifically for the inflows. So the first thing with the indirect method is that I'm going to start with net income. So let's find that number. So I've got net income here on the statement of income. The bottom I can see net income is $91,480. Okay. So the next thing I'm going to have is a line that says adjustments. Whoops. So we're going to put here adjustments to reconcile to net cash from operating activities. Okay, and now we're going to be looking for anything that's not cash. So the first thing, the easiest thing that we usually start with is depreciation expense, because we know that depreciation expense is an accounting concept. There's no actual cash outflow associated with depreciation expense. We have a cash outflow when we purchase the asset, but not in the way that we're going to depreciate it for accounting purposes. So if we take a look at the income statement, we can see depreciation expense is broken out here. So we know that it's $58,700. $58,700, and I'm adding that back because depreciation expense would have been deducted from net income. And so by adding it back, I'm basically negating the impact of it on net income from a cash perspective, because from a cash flow, there was no cash outflow associated with that. So I'm basically taking net income and adjusting it from an accrual basis to a cash basis. Okay, so we got net income. What else do we see? Let's look at our income statement and see if there's anything else that jumps out at us. So a gain on disposal of land is an accounting concept as well. The gain or loss doesn't result in more cash. What matters is we know we're going to need to have proceeds from the investment in land, but not the gain on the disposal. So we can add the gain back. And when I say add it back, what I mean is disposal of land. So it's a gain, so it's adding to our income. So we actually need to take it out because what we're trying to do is make it so that it doesn't have an impact on net income. And the gain here is 5,000. Okay, then we've got a gain on disposal of equipment, and it's the same thing. So we're gonna take that away from net income because it was previously added. So to have it, to make sure that it has no effect, we need to take it out. 3750. Okay. And then we're gonna have, what else do we have here? So we've got these gains on land and this. Okay, I don't see anything else. We've got depreciation expense. There's nothing else on the statement of income that really jumps out at me as a non-cash item. So the next thing that we do for the indirect method is we start going through the working capital. And what I mean by that is we're going to do the change in all the current assets and current liabilities, excluding cash. The reason that we exclude cash is because, as you know, at the bottom of the statement of cash flow, we're going to be reconciling back this cash balance. So we're going to deal with that separately. I mean, that's really the whole purpose of what we're doing here, is to explain that movement. So let's start with accounts receivable. So we simply say if it's an increase or a decrease. So did accounts receivable increase or decrease? Well, it went from 37,000 in 2019 to 90,800. So it definitely increased. So we're going to have increase in accounts receivable. And what does an increase in accounts receivable mean? Well, an increase in accounts receivable means that we got less cash because we're extending more credit through AR. So it means that we're getting less cash, meaning that we're going to deduct the increase in AR from our cash flow statement, because it's reducing our cash inflows. It means that from when we recognize revenue, obviously it doesn't matter to us whether we recognize whether we've got the cash or not, because from an accounting concept, what matters is whether the revenue is earned. But from a cash flow perspective, we're not interested in whether the revenue is earned. What we're interested in is whether we got cash in for the revenue. And so the change in AR helps us approximate, or helps us understand, if we extended more credit or less credit. Okay, next we've got the change in inventory. So did inventory go up or down? Well, it was 37,000 in 2019, and it was 102,650, and now it's 121,900. So it also increased. And we're going to subtract this because we use cash to buy inventory. So if inventory went up, it means that we use cash to buy it. So I've got 121,900 minus 102,650. And then I'm just going to multiply it by -1. That's how I manage the signs here. Okay, so I've subtracted the increase in inventory because we use cash to buy the inventory. So we need to deduct it from our cash flow or we need to show it as cash outflow. So it looks like I've got all the current assets. So we know we're not dealing with cash right now. I've got AR, inventory, and the investment in land is not a current asset. That wouldn't be expected to change in a year. So we'll leave that alone. PP&E, those are long-term assets. So let's take a look. Let's turn our attention to the liabilities. So what current liabilities do I have? Well, it looks like I've got accounts payable and accrued liabilities here, because notes payable is a long-term liability. So let's deal with the changes there. So did accounts payable increase or decrease? Well, it was 48,280, and now it's 52,700. So it increased. So I'm going to have increase in accounts payable. Now, am I going to add this or subtract it from the cash flow statement? Well, it's actually a good thing. The less that we pay to our suppliers, the more cash we get to keep. So the fact that AP went up is actually a positive cash inflow. So this is going to have a positive sign. So I'm going to say 52,700 minus 48,280, and that's going to be a cash inflow for the net change, which is 4,420. And next I'm going to have accrued liabilities. So accrued liabilities went from 18,000 to 12,000, so it decreased. So I'm going to have a decrease in accrued liabilities. And decreasing in liabilities means that we must have settled the liabilities in cash. So this is going to be a cash outflow. So this is going to have a negative sign. So I'm going to go 18,830 minus 12,100 times -1. So I've got my cash outflow there of $67.30. And now I've dealt with all of the items on the income statement that were clearly non-cash. And I've gone through all the working capital. So I've covered off all the current assets with the exception of cash, of course, and I've covered off all of the current liabilities. And now all I have left on my statement of financial position are long-term liabilities or equity. So I know that I've finished my cash flow from operating activities section. So I'm going to put here, I'm going to run a subtotal here just to ease the summing process of all the adjustments. And this is also going to give me an idea of whether I've got cash used by operating activities or cash provided by. So I can see that I've got an inflow of 91,000 and an outflow of 17,000. So I'm going to have net cash provided by operating activities. And that's going to be the sum of the two. So I'm going to have this plus this. So my cash provided by operating activities is going to be, let's check this number here. So we've got 91,480, we've got 58,37,5. Let's check this one. Did I do the wrong numbers in here? Let's take a look. AR 37,000. Yes, I did. It's something really to watch out for because I do find that sometimes as I'm going through these questions, I do pick up the wrong numbers from the balance sheet. Okay, let's do AR again. So what's the change in AR? We've got, it went from 90,800 minus 37,000 in the previous year. Okay, there we go. 53,800 is the right number. I just picked up a different number from the statement of financial position there. So definitely a warning to you. It's really important to be really careful about what numbers you're picking up. And then now I've got the correct cash provided by operating activities, which is 66,070. So my next section on my statement of cash flows is going to be cash from investing activities. And here I'm going to be looking to my long-term assets. So we know that we have we sold some land because we can see it on the statement of income. It says gain on disposal of the investment in land. So we must have proceeds from the sale of land. And what else? We've got a gain on disposal of equipment. So we must have proceeds from the sale of equipment. And anything else here that we can see? Well, I mean, we need to deal with the change in PP&E and accumulated depreciation, but those accounts are going to be how we're going to figure out these proceeds. We don't actually work through. So for the current assets and current liabilities, how we have the increase or the decrease in the account, we don't do that in the other sections, even under the indirect method. So we're not going to say increase or decrease in PP&E here, because in the investing activities section, what we're looking for is simply the cash that we receive for disposing of any assets or the cost of purchasing any assets. So we're only interested in proceeds and purchases. So we're not going to have any sort of change in financial statement accounts or change in balance sheet accounts or statement of financial position accounts here. But working out the proceeds and the purchases definitely is complicated and will require us to piece together the change in these accounts with what we know to get these amounts, because these amounts, it looks pretty simple, but unless you're given the details in the supplementary information, it isn't quite as simple as it looks. But of course, it's very manageable if you know what you're doing. So let's get started there. So we need to, let's start with the land. So let's just move down here and let's do a little section at the bottom. Let's actually go underneath here. So we're going to figure out the investment in land. So the investment in land. So what we know is that on our statement of financial position account, we do have a line called investment in land. So let's figure out what the opening and closing balance of that is. So let's say investment in land. So let's go December 31st, 2019. Balance is going to be, what did we start with there? So we started with investment in land, so 107,000. And then we're going to have our December 31st, 2020 balance, which is going to be, what's that going to be? Investment in land, 84,500. Oops. Over here, 84,500. And this is our December 31st, 2020. So we can see the change in the account balance. So the change, and this is really all we're piecing together here, just like we used for the other accounts. So the account went down by 22,500. But we know that we had a gain on the disposal that we picked up on the income statement. So what was the gain? So the gain on the land was 5,000. So that means that the proceeds from the sale must be the sum of the change in the account, because we would have removed the land when we sold it. And we don't have any depreciation to deal with here because, as we know, we don't depreciate land. So that makes this piece a tiny bit easier. So the proceeds from the sale then must be 27,500. And what you can see is it's simply the sum of the change in the account plus the gain on the disposal. And why is that? Because when we sell the land, we would credit the account to take out the cost of the land that we had sold. And then we also had a gain going through the income statement. So the cost plus the gain must be the cash that we received from selling the land. So now we've got this amount we can put up onto our cash flow statement. So we've got 27,500. And that's an inflow because, of course, when we get cash from selling something, we're going to have an inflow from it. So then we've got the proceeds from the sale of equipment. So let's see what we've got there. So let's do the same thing for equipment and see where we can get to. So let's go equipment. So we're going to have December 31st, 2019 balance. So what was our PP&E balance then? So we have PP&E is going to be 205,000. Okay, and then December 31st, 2020, it's going to be, let's take a look. PP&E is going to be 290,000. So the change in that account is going to be, so it went from 205 to 290, so it increased. So let's see what we have here. So it increased by 85,000. And what else do we know about land? We really need to be careful that we have checked the supplementary information. So we've got investments in land were sold at a gain. We know that from the income statement. That was kind of pointless. Equipment costing 56,000 was sold for 10,550, resulting in a gain. Okay, so that's interesting. So we've got this increase. We know what the cost of the equipment is. The cost of equipment sold. We're told right there in supplementary information number 2 that the cost of what was sold was 56,000. So let's take that off. So we've got 56,000. That's the cost of what was sold. And then what about, do we have any other information? It resulted in a gain. It was sold for 10,550. That might help us with the proceeds. Well, the proceeds then are 10,550. Actually, it just gave us that number. So all we're looking for here is the change in the account must give us the purchases, 10,550. So we've got that number, which we were given simply in the supplementary information, but then we've got purchases of PP&E. So let's see what we've got here. So purchases, so we've got this amount was what was sold. And then let's see what else we've got. Common shares were issued in exchange for some equipment. So that's interesting. So common shares were sold for some equipment. How much, what was the amount of common shares? that was issued. Let's see here. So common shares went from 200 to 250. So common shares went up by 50,000. So that means we must have issued 50,000 common shares in exchange for the equipment. So the journal entry we would have recorded when we would have recorded for that transaction would have been debit PP&E, credit common shares. So it's a non-cash flow item. So it's not going to show up on our income statement specifically, but what it does mean though is that it would have increased our PP&E account. And so as we're trying to reconcile this, we do need to take into this. So the purchase through shares is going to be, so we're going to have here, we're going to have $50,000. So then what is our purchases of PP&E? Cash. Remember, we only want the cash purchases, not this amount from the purchase through shares. So we're actually going to take that off of our reconciliation because it's not cash. And the equipment sold gave us cash. So let's see. So we've got the change in this account plus the cost of the equipment sold. Sorry, the change in this account minus the equipment sold. Let's see what we've got here. This account, oh yeah, I missed this minus 50. Ah. Okay, let's fix this. Here we go. Okay, and we've got 91,000. So let's take a look at what we've got here. So we've got the change in the account. So we say, okay, over the year, PP&E increased by 85,000. So does that mean we purchased 85,000 of equipment? Well, it would if that was the only thing that had gone through the account. But we also reduced the account by some of the equipment sold. And we had the purchase of equipment through shares, which would have been a non-cash item. So that means that of this amount, we're going to have the sum of the 85,000 and the cost of the equipment sold is going to give us our purchases of PP&E, which is going to be 91,000. Why are we adding the cost of the equipment sold? Because we must have replaced the equipment sold with that much more of an asset. So we would need to have bought 91,000 to be able to offset the cost of the equipment sold, which of course would have been deducted from the account, and the fact that the purchase through shares would have been an offset to the account. Well, didn't include cash. So from a cash basis, then we would have had to have bought 91,000 of, we would have had to have bought 91,000 of assets. So this is the purchases of PP&E during the year. So let's bring this amount up here. Now we're going to have, and this is a cash outflow, of course, when we buy assets, we're paying money for it. So then we've got all of our net cash from investing activities, and this is going to be a net cash outflow. I can simply sum it here and see it's a negative. So I'm going to say net cash used by investing activities. I'm going to just sum these. And I can see there that the company used $52,950 in the investing activities. So we got the money from selling land and selling equipment, but we purchased $91,000 of new PP&E. All right, so let's finish off our last section here. So then we're going to have cash from financing activities. What are financing activities? Well, here we're looking for long-term debts or equity. So let's take a look at what we have in our statement of financial position. So we've got notes payable, which would be a financing activity, and we've got equity. So let's start with that. So we've got the notes payable. So what happened with notes payable during the year? So notes payable went from 70,000 to 140,000. So it means we must have notes payable. We must have received an additional amount of debt of $70,000. So this is going to be a cash inflow. It means we must have received cash for that $70,000 from the bank or from whomever's financing us. So we're going to have, this is going to be called issuance of notes payable. If we look at our supplementary information, let's just see if we have anything here. Common shares were issued in exchange for equipment. The remaining purchases of equipment were paid for in cash. And we've got this equipment. We dealt with the cost of the equipment, and we've got the gain we added back in the operating cash, the operating inflow section. So we've dealt with that one, and we've dealt with the investment in land. So I think we're pretty good on the supplementary information there. Okay, so we've got the issuance of note payable. And then we also need to take a look at so we dealt with common shares. We know that's not a cash transaction, so we don't need to pick up anything for that. But we do need to take a look at retained earnings and do a reconciliation there to see if any dividends were issued during the year. So let's do a rec of retained earnings. We're going to go December 31st, 2019. What was the balance of our retained earnings? So we had $121,790. Now we're going to add net income. So what was the net income for last year? Do we have a comparative income statement? Well, we have 2020 income, so that's what we're going to add 91,480 because we're trying to get to the December 31st, 2020 balance. So 91,480. And we would have had our expected December 31st, 2020 balance, which should be the sum of these two. You can see what I'm doing here is I'm basically saying, well, what I would expect retained earnings to be is the opening retained earnings plus the net income for 2020. That should give me my December 31st, 2020 retained earnings. And my actual December 31st, 2020, see if it matches. My actual retained earnings were $175,600. So what's the difference? So I thought it was going to be this, but it was actually this. That means that we must have issued dividends or declared dividends of $37,670. And this is a declare because it would go through a payable account, but because we don't have a dividend payable account on our statement of financial position, we can assume that this was paid in cash. So let's show that as a deduction or a cash outflow in our investing activities section. So 37, or in our financing activities section, my apologies. So we're going to have dividends, payment of cash dividends. And here we're going to have the outflow of $37,670, which is what we just calculated. And that gives us everything. Now, the way that we know that we've got everything is because we've dealt with all of our current assets. We've dealt with our capital assets. So we've dealt with land and PP&E. And we've dealt with our financing or investing section, sorry. So we've dealt with our notes payable, and we've dealt with equity. So let's put a total here. So this is going to be a net cash inflow. So net cash provided by financing activities. So this is going to be this amount. Oops, actually, we're going to sum it over here. Okay. All right, so now we've finished off all of our sections. So now is the moment of truth. So now we're going to have net increase in cash, because I can tell it's going to be net increase because I've got 66 minus 52 and plus 30. So I'm simply going to run this total through from my cash flow statement. So that is what my cash flow statement is telling me. So basically adding up everything through my cash flow, it tells me that I should have a net increase in cash of 45,450. Now the question is that actually going to match the statement of financial position? Because you know right away if you got it right or not. So cash January 1st is going to be, what was our opening cash? Remember how we said we hadn't used this line item on the statement of financial position yet? Well, here we are using it. 47,250 and cash December 31st is going to be, what is it? 92,700. And let's see if these things match. So what's the change in cash? Just run it over here as a small subtotal. So our cash went from 47, so it increased. So we know at least we have the right direction. And look, from our statement of financial position, simply looking at the change in these accounts shows that our cash went up by 45,450. And look, our cash flow statement picked up a positive change of 45,450. So that's amazing. We know we got everything right, which is perfect. Okay, so that is our indirect method. So you can see here how we started with net income. And then in our operating activities section, we reconciled through. We looked through the income statement and we picked off anything that was not a cash item. So we identified depreciation expense and gain on land and equipment. And then we reconciled the changes in our working capital account. So other than cash, all of our current assets and current liabilities. So you don't want to pick up PP&E here. That is an investing activity, but you want to pick up all the current assets. PP&E is a long-term asset. Now, we're not seeing classified balance sheets here, so you need to know what's current and what's not current. That gave us our cash flow from operating activities. Then in investing activities, we had to figure out the proceeds from the sale of the land. Remember, we don't care about the gain here. What we're looking for is the cash flow. And that required us to reconcile through the changes in those accounts and making sure that we're looking at that supplementary information because it often relates to PP&E because that's where the more complicated calculations can arise. So we needed to know the proceeds from the sale of anything or the purchase of anything that is a long-term asset, and that goes in the investing activity section. Next is the financing activities, and this is anything that a company's done to raise money during the year. So here we're looking for notes payable, issuance of common shares, assuming it was for cash, payment of cash dividends. So we always want to make sure we're reconciling through that retained earnings account to see if it matches our expectation. Otherwise, there could be dividends that have gone through there that we need to identify. We're not often told that there are dividends in the supplementary information. Sometimes we are, but often we're not because it's a catch you need to find on your own by reconciling that retained earnings account. So I would always do that. Then we came down to our net increase in cash. So the first line is simply what our statement of cash flows told us the change in cash was. Then we brought in the cash numbers from the balance sheet or the statement of financial position, and we double checked to see if the change in these accounts on the statement of financial position actually reconciled what our statement of cash flows told us, and it did. That means we know we got everything right. Okay, so we've done A, which is prepare the statement of cash flows for December 31st using the indirect method. Now in B, we're asked to prepare it using the direct method. So let's see what that looks like. How is the direct method different? Well, the good news is the direct method and the indirect method are only different for operating activities. Investing activities and financing activities are identical between the two methods. So for B, we only need to worry about the operating activities section. So now we're going to be using the direct method and see how that contrasts from the indirect method that we just used. So the direct method, what it prevents is we don't bring in net income and we don't add back all these things. And we don't just reconcile the statement of financial position accounts. It's quite different in terms of the approach. What we're looking for is specifically what came in terms of cash and what went out in terms of cash. So we don't start with net income. We're not starting with accounting income and adjusting it to a cash basis. We're simply starting with a cash basis. So the first thing we're going to have here is we're going to have our operating activities section. So cash flow from operating activities. Okay, so we're going to start here. So that one of the first items that we're going to need is cash collections from customers. So these are pretty common headings. So I'm just going to bring these in and then we'll modify them as we go. Cash payments to suppliers, cash payments for operating expenses, cash payments for interest, and cash payments for income taxes. So basically we're looking for all of our main our main categories of cash inflows and outflows. So let's just start with cash collections from customers. So what the direct method does require is it does require us to prove out these accounts, because you're not just going to be able to look at one of the statements and pick up the cash flow or pick up the cash collections from customers. So how do we calculate cash collections from customers? Cash collections from customers. Well, we start with sales revenue, which we can take off the income statement. Find that number. So we've got sales revenue of $297,500. And we're going to adjust it for the change in AR. So let's see what happened with AR during the year. So AR went from 37,000 to 90,800. So AR increased. So we're going to deduct the increase from AR, because remember, as we extend more credit, we're going to get less cash in. So deduct the increase from AR, which is going to be, let's get that number. So AR is going to be, let's see, so 90,800 minus 37,000. So let's deduct that. You really have to be careful with your signs here. So the way I do it in my formulas is I always just take the bigger number less the smaller number, and then I decide whether it's going to be negative or positive. So then this is going to give me my cash inflow from customers, cash collections from customers, the sum of these two. So 243,700, and I'm going to bring this up into this line, 243,700. Cash collections, oh, sorry, that's the wrong line, my bad, 243,700 right here, 243,700. Okay, so cash payments to suppliers. Let's see, where are we going to find this? So we have cost of goods sold here. So what are we going to have for cost of goods sold? Well, cost of goods sold and inventory are the two connecting accounts there. So cash payments to suppliers. So we're going to start with cost of goods sold from the income statement. And let's find that number. So we've got a cost of goods sold here of 99,460. And we're going to figure out what the change in inventory was, because when we're recognizing cost of goods sold, we're deducting from our inventory. So inventory went from 102,650 to 121,900. So it increased. And increasing in inventory means we must have used cash to purchase inventory. So we're going to deduct an increase from inventory. Deduct increase in inventory. So let's figure out what this number is. So inventory really doesn't like it when I do that, does it? Okay. Inventory is going to be 121,900 minus 102,650. So we can see this number here, and we need that to be a negative. Okay, so we're going to deduct that, and this subtotal is going to give us our cash payments to suppliers. So 80. So let's see here. What do we have? Cost of goods sold. Oh, and then you know what else we need to take into account here is we're going to assume that accounts payable relates to cash payments to suppliers. And it does usually. If you think about what goes through accounts payable, it's payments to vendors. So what happened with accounts payable? Well, it went from 42,000 to 52,700. So we're going to deduct an increase in AP. So we're going to have, and actually here, let's think about this. So cost of goods sold is a cash outflow. So the fact that we used money to purchase inventory means we're actually going to add it to it. And the reason why is because it's more of a cash outflow. So like I said, we used cash to purchase inventory, but because now here we were talking about a cash inflow, this is an outflow. So using money to purchase inventory is actually going to increase our cash outflow. So an increase in inventory is actually going to be added here. But AP, if AP goes, let's think about this. So AP is going to going to happen to AP? So AP is going from 48 to 52. So we are increasing our AP. That means we spent less money, or it means we paid less money to our vendors because we saved money. The less we pay through AP, the more cash we have. So this is actually going to reduce our cash outflow. So it's a good thing. So we're going to deduct it because here we're calculating a cash outflow, if that makes sense. So we're going to have 52,700 minus 48,280. 52,700 minus 42,280. I hope that's right. It is not. Let's figure out this AP account again. Where is AP up here? So we've got 48,280 or 52,700 minus 42,280. Okay, is going to give us, it's going to give us, am I picking up the wrong account for AP? What's happening here? AP 48,280. Let's just see here. So it went from 52,700 minus 42,280. Apparently I can't calculate this either way. 52,700 minus 42,280. It's going to give me $4,220. So let's subtract that from here. So we're going to have, where is this here? So we're going to have minus 4,280. So then this is going to give me my cost of goods, my cash payments to suppliers. So my cash payment to suppliers are going to be 114,290. And I'm going to pick up this number right here as a cash outflow. Okay. All right. So now what about cash payments for operating expenses? Okay. So not surprisingly, we're going to start with operating expenses from the income statement. So that number is 14,670. And then we are going to figure out what happened with our accrued liabilities because we're accruing operating expenses in there. So accrued liabilities went from 18,000 to 12,180. So that means we must have used cash to reduce that AP balance. So we're going to add that to this because this is a cash outflow. So add increase in accrued liabilities. Or the decrease, sorry, decrease in accrued liabilities. So that decrease is going to be 6,730. So this total is going to give me my cash outflow payments for operating expenses. So 21,400, and I'm going to put this here, of course, as an outflow. So it's got to be negative. Okay. Payments for interest. Well, interest we can take right off of the income statement. So let's see what we've got here. Interest expense is 2,940. So let's put that in here, 2,940. And payments for income taxes. We do have income tax expense going through our income statement, so we can use that as the cash payment for income taxes, 39,000. There's no income tax account, so we're going to use just that income tax expense from the income statement. So this is going to give us all of our cash, net cash provided by operating activities. And here's the clincher. We have to get the same number from the direct method and the indirect method. So even though we've come at figuring out our net cash provided by operating activities completely differently between the direct method and the indirect method, the number has to be the same. So we can't have a different cash inflow from the two. It's the same. It's a fact what we got in from the net cash from operating activities. So here I've got 66,070, and let's move up and check our direct method, our indirect method up here, sorry. Look, 66,700. So we got the exact same number, even though here we took net income, we reconciled it for anything that wasn't cash, and then we just did the change in the current assets and current liabilities. Down here, we actually said, we actually determined what all the cash flows were going to be. And then we had to go through and calculate out each amount and we got to the same number, which is perfect. That's exactly right. And that's what has to happen under both of the two methods. So you can see under the direct method, we didn't bring in net income or any of the non-cash items from the income statement. You're not going to bring in depreciation expense or gains or losses. You're simply going to say, what did we get from customers? What did we pay to suppliers? And interest and income taxes, depending on what accounts you have on the statement of financial position, you may be able to just take these straight off the statement of income. Okay, so now we've done B. And C says, if North Road had followed ASPE, would it have a choice in how it classifies dividends paid on the statement of cash flows? And no, it wouldn't. So ASPE does not permit a choice in the classification of the payment of incomes. Dividends have to be classified as a financing outflow. But because North Road follows IFRS, a choice was permitted for dividends paid. You can choose either a financing outflow or an operating outflow. And remember, in the beginning of this question, we were told that it says the company follows IFRS and North Road has adopted the policy of classifying interest paid as operating activities and dividends paid as financing activities. And they're only allowed to have that policy adoption because of the fact that they're under IFRS. If they were under ASPE, they would not have a choice and they would have had to classify the dividends as a financing outflow. All right, and that takes us through this question.